Hey everybody, Rob Maurer here. Happy Friday. Today we are going to be talking about Tesla's credit rating. Moody's has actually responded to an inquiry about why Tesla is not investment grade rated by them. So we'll talk about that explanation and some of the implications around that. And then we do just have a couple of other quick items as well, but should be a little bit quicker of an episode today. Tesla on the day today down 2.5% to close the week at $270.21, while the NASDAQ was down 1.3% on the day today. This is the sixth red day in a row for the NASDAQ. We'll see if any of that can change next week, as we will have a short week with the Labor Day holiday on Monday. So markets closed, likely no episode as well. Then through the rest of the week, we'll have a couple of economic reports, but really the following week will be the major week with the Consumer Price Index report and the Producer Price Index reports coming on Tuesday and Wednesday respectively. The following week after that, we will of course get the FOMC meeting and interest rate decision for September. Also, an item to keep an eye on, Tesla has said previously, or Elon has said previously, that on Monday, September 5th, Tesla would be increasing the price of FSD to $15,000. So something to watch out there for on Monday, and if you're trying to get an order in, maybe get that in this weekend. Quick macro item to continue to watch here. Russia has now announced that they are indefinitely suspending natural gas flows for the Nord Stream 1 pipeline. So Russian natural gas into Germany. Talked about this earlier this week. It was supposed to just be down for 3 days for maintenance. Now down indefinitely. The reason that they have given is a technical fault that they have discovered. I think we can all, assess the accuracy of that statement, but certainly something that Germany has been preparing for, probably not entirely unexpected. But still some risk because of this to Germany's energy supplies. We'll have to continue to monitor that through fall and through obviously winter. Could be some risk for Tesla at Giga Berlin in terms of the power that they have available to them. Natural gas would be something that Tesla uses for their casting machine. So thankfully we have seen Tesla stockpiling these castings. Hopefully that will alleviate some of the risks that they may have due to this situation in particular. But again, something that we'll continue to keep an eye on the impacts and implications of. All right, let's talk about this credit rating agency stuff. So here we can see how these ratings are structured. So we've got Moody's and S&P Global primarily. Tesla right now, from both of these ratings agencies, is rated just one notch below investment grade. So at Moody's, they're rated Ba1. At S&P Global, they're rated BB+. Why does this matter? Well, it affects, credit rates or interest rates that you might get on debt. And it also affects the investor pool for Tesla. Some funds, some institutions, they're just going to completely look at it from a perspective of, if this company is not investment grade rating, we will not invest. That's just a guideline that many funds have. So it limits the demand pool for Tesla stock. They're therefore sort of acting as a suppressant for the share price. So we'll talk a little bit more about that, but Alexandra Mers, who used to work for these credit rating agencies, I can't remember which one specifically, I think for Moody's actually, but she has been trying to raise awareness to where Tesla's financial position is versus how their credit rating sits and how out of whack and out of line those things are. So she's been tweeting kind of at Moody's every day, at S&P every day, trying to raise awareness of this and just try to get a response on why these agencies have these credit ratings. So she did actually receive a response on this today. We'll take a look at that in a second. But just to quickly highlight why this is even, such a huge question, she's done some really great work putting together a compilation of Tesla's sort of financial ratios compared to other companies of their stature in terms of market cap. So here we've got the highest market cap companies of the S&P 500, and we can see, Tesla here, high market cap, extremely strong financial ratios across cash to debt, debt to equity, debt to EBITDA, debt to revenue, Altman Z-score, which is just a sort of formula to capture a lot of these different debt type of ratios. Incorporates 5 different measures. We don't have to go through that right now, but Tesla on that Altman Z-score, outperforming pretty much every company on this list. In fact, it looks like every company on this list, and among the top 5 across all of these other ratios. Not that that's all that needs to be looked at, but it shows how strong Tesla's financials are. A lot of that due to Tesla having paid down their debt. We've talked a lot about this. Tesla really not sitting on any debt. Last year they had $5.1 billion of debt, excluding vehicle and energy financing. This was as of Q1. They paid that down to just $88 million. Now it's even below that. I think it's around $50 million right now. So that's what's driving a lot of the success in these financial metrics. And then that slide that I just showed here, we can see Tesla's business, it's just following that S curve up, just continues to grow. Operating cash flow over the last 12 months continues to grow. Free cash flow continues to grow. Net income, like it's all up and to the right, just like you'd want to see. So in addition to these strong metrics, you've got them growing and improving quarter by quarter. And yet here Tesla's credit rating sits third last among all these companies that are on these lists, just below a couple of automakers, but dead last in terms of these top 25 or 28 companies in the S&P 500, despite these financial metrics having some of the best strength relatively. I mean, just look at Apple, highest market cap company in the world, AAA rating from both Moody's and A+ from the S&P, which we can see top for Moody's, second from the top for the S&P or from S&P, and Apple across all of these metrics sitting below Tesla. So huge question, why is this happening? Moody's did respond. They said to Alexandra, thanks for reaching out. For reference, copied and pasted our considerations for an upgrade of Tesla. The considerations are not so much of a quantitative nature, so not looking at those financial metrics, but more qualitative. Importantly, we are looking for a broadening of the company's product lineup. Today, Tesla remains narrowly reliant on primarily two models, albeit highly successful ones. Note also in this respect that one of those models was first introduced in 2017. Don't know why they included that. More concrete prospects for a broader vehicle lineup would be regarded as a positive development in this respect. So then they just pasted their the piece of the note that covered this back when they had previously upgraded Tesla to the current level, just below investment grade, in January. So that was the last action that they had seen from Moody's on the credit rating. And here just highlighted that main point. So they talk about could be upgraded if Tesla expands their global footprint. Check that box. Maintains competitive global presence. Probably check that box, despite increasing, EVs on the market, and improves its product breadth. So the and there kind of makes it saying, reading to me as Tesla's kind of got to do all of these things. So on one hand, you've got Tesla's extremely strong financial metrics, and then on the other hand, you've got Moody's kind of saying, hey, since we really can't defend this in any quantitative nature, well, then we must defend it from a qualitative perspective. And when it comes down to this at the end of the day, I think that's really what Moody's is doing, is just trying to find any reason that they can to justify this, because my guess, you can claim manipulation or whatever else you want to do, and that's fine. Like, I think those theories have some validity too. But I think probably more the reality would be that Moody's is just slow moving, right? Like, it's not really any different than what we see with investors. Investors have not had a lot of confidence in where the trajectory has been heading because of all of these risks that they kind of perceive to be there, like competition, lack of product diversity. How is Tesla going to get to this scale with this few of models? These things, they're kind of understandable as questions, unless you're following Tesla as closely as this group of people is. Once you start to understand why Tesla is doing these things, particularly why Tesla only has two models and all of the benefits that brings for Tesla, and that there would be no point to have additional models when Tesla can't even fulfill demand for those limited models, you start to understand that, it wouldn't make sense to be doing this in any other way than Tesla is doing it. But I don't know that it's necessarily, I'm trying to find the words here, but I don't want to say it's necessarily unfair to expect the rating agencies to have that kind of level of detail. They probably should if they're doing this. But at the same time, I think we have to acknowledge the reality of the situation that they just don't, right? They should, but they don't. So given our knowledge and given the discrepancy of our knowledge versus the collective investing community's knowledge of Tesla, I think it's kind of understandable from a perspective of what we have seen Tesla achieve is really unprecedented, right? Like, there aren't companies that do what Tesla has done this quickly. So I think it's fair for them to be a little bit slower moving when that's sort of in their culture, in their DNA as a credit rating agency. They're not going to be on the leading edge of things. Again, maybe they should be, but it's not the reality of the situation. So to illustrate this, we can just look at a slide that Tesla showed at their shareholder meeting, cumulative profitability since inception. For the last decade, we've seen Tesla just losing money, right? Losing more and more money constantly. This finally flipped a couple of years back. This finally changed. And then we really saw it take off in 2021. But we've only got 1 year of history there, right? So I think it's understandable for these rating agencies, for more conservative investors to just be a little bit slower moving, take a little bit more time to make these adjustments when they see more of a track record of success. So what I think Moody's is really doing, what I think the words that they want to say, and maybe they're not saying them for whatever reason, I think they just want to see a longer track record of success from Tesla. I think once Tesla goes and does this for a longer period of time, and once people see that, hey, yet again, competition is not going to be what destroys Tesla, they're going to be a lot more comfortable with increasing these types of ratings. So again, it's not necessarily to defend the rating agencies or anything like that. Like, again, I think it is important to be raising this and highlighting, as Alexandra has done here, how big of a discrepancy there is between Tesla's actual financials and their credit rating. But at the same time, if you look at all these companies, like, these are companies that have had earnings or cash flows like this for a long, long time. I would imagine that there's never been a company in history that has gone from a financial picture of this to what we see now today in 2022 as quickly as Tesla has done. And if there are examples of that, I would wager as well that credit rating agencies also in those circumstances lagged behind the reality significantly. So those are kind of my thoughts on it. Again, I don't think it's, perfect explanation here from Moody's. It's kind of interesting. We see the exact same thing from S&P here. If we look at their note from their upgrade, they talk about, to sustain strong growth, to hold its first mover advantage and maintain market share, the company has to expand its range of products. So they're saying Tesla has to expand their range of products when they're talking about their future outlook for Tesla and when they could potentially increase their rating. So, the S&P kind of saying similar thing. Furthermore, Tesla will need to contend with rising competition. So exactly what we just talked about. They're expected to launch 40 new EV models by the end of 2022. This is because many of them have the capacity and vertical integration capabilities to bridge the cost gap over time and also leverage their existing customer base and brand power to command pricing power. This is talking about legacy auto, right? Like, anyone that follows Tesla closely would never write this sentence because everyone understands legacy auto is not getting any pricing power advantages over Tesla. It's not going to happen because of Tesla's vertical integration, because of Tesla's software leadership, because of Tesla's manufacturing prowess, because of Tesla's history with electric vehicle manufacturing. Tesla's ahead on all of these facets. There's no chance of something like this happening. Sure, some competition could maybe suppress Tesla's margins a little bit from where we're at now or where we project them to go. But you're not going to see some sudden leapfrog like they kind of suggest would be a possibility here. So once Tesla has once more time goes by and this becomes harder and harder to defend, well, then these agencies will have no choice. So that's kind of where it's at. I had to kind of chuckle too, because one of the things that Moody's talks about here is that they would like Tesla to broaden their model lineup, and S&P obviously saying the same thing. But then they kind of also unwittingly give credit to Tesla because of what Tesla's able to do based on that product strategy. So they talk about, despite semiconductor shortages and other supply bottlenecks, Tesla appears to have minimized production disruption relative to most automakers. Well, there's a reason for that, S&P, and that's exactly what you're criticizing down here. Again, this is S&P, not Moody's, but exactly what they're criticizing is product breadth. And one of the reasons Tesla's able to manage so well through the supply chain disruption is because of that product simplicity, which, if you just flip those words around, becomes a strong advantage. So hopefully that kind of makes sense in terms of where the credit rating agencies are coming from, where Tesla's actual business is at, and the disconnect between the two that will hopefully just alleviate as more time goes by. So that's kind of what I expect. In terms of, does this matter, again, coming back to, does this even affect Tesla? It does, because investors aren't going to invest. There's just a pool of investors that aren't going to invest at any company that's not investment grade rating. I don't know how important that is to Tesla right now, right? Like, I don't know how important it should really be to us, because it's just like when S&P delayed putting Tesla on the S&P 500, right? There was a quarter where they could have done it and they didn't do it. They waited, and everyone's having a similar complaint of like, hey, this is not justified. Tesla needs to be in the S&P 500. You're losing opportunity. You're hurting your investors. All true. What that gave, though, was an opportunity for investors that can actually see these things, can actually understand what's going on here with Tesla's business opportunity, right? So yes, it's important to raise awareness to this and why it's wrong, and to hopefully get the credit rating agencies to be better at their jobs, frankly, than they are right now. But at the same time, recognize it, understand that this is actually an opportunity. This is just like it was an opportunity to invest in Tesla before they got into the S&P 500. It's an opportunity right now to invest in Tesla before they get into an investment grade credit rating and open up access to the stock for billions and billions and billions of dollars of assets under management that are going to then demand it, increase the price, reduce the float. So that's where we'll leave it for today. So as always, thank you for listening. Make sure you are subscribed and signed up for notifications. You can also find me on Twitter at Tesla Podcast. And we'll see you on Tuesday for the September 6th episode of Tesla Daily. Thank you.